Yes. In last session, we have started with Unit 1, that is Introduction to Financial Accounting. So in that we have seen what are the objectives, functions of financial accounting and principles on which the whole financial accounting is carried out. Now this is Unit 2, Accounting Mechanics. So in this unit, we are going to take overview of exact procedure of recording business transactions into books of accounts. Now, this particular method is very systematic and universal. So, first we are going to see principles of double entry bookkeeping system. We follow double entry bookkeeping system, which is legally allowed and legally enforced on businesses. Now, as per the double entry bookkeeping system, every business transaction involves two accounts. We have seen accounting concept. In dual aspect concept, we have seen that every transaction has two aspects. So same is reflected in the principles. Every transaction involves two accounts. One account is giver of the benefit and other account is receiver of the benefit. So you have to always think from business point of view. So for business, when the business is giving something, it is receiving something, and when the business is receiving something, it is giving something. So this is called the principle of bookkeeping, that is called double entry bookkeeping. So the two accounts are involved. One is receiver of benefit, other is giver of benefit. Now on this basis, one account gets debited and by the same amount other account gets credited. So the same amount entry we will pass in the journal of any business transaction. So it is like a balance. One account gets debited, by the same amount other account gets credited. So it is called double entry and the balance is always same. Debit is equal to credit. From the initial step of recording business transaction into journal, this step is followed. Now we will see, in India we follow generally accepted accounting principles, that is GAAP. These are the scientific principles established after a usage over a long period of time. Accounting process becomes more logical and consistent, and it brings uniformity, universality, credibility and reliability in the financial statements. Now we observe that there are various transactions all over world. So one country, there are various transactions in between two countries, import, exports, mergers, acquisitions. Now while doing this, there has to be valuation of business. Now if every country or every businessman following different accounting principles, it is not possible to make these type of transactions. So these generally accepted accounting principles gives us uniformity of accounting, books of accounts and financial statements. So valuation of firm becomes easy and other transactions are possible like mergers and acquisition. So what is accounting mechanics? The accounting mechanics means applying the accounting principles and following the procedure for finding out the end results. So they are classified into two, accounting concepts and accounting conventions. In last unit, we have seen in detail all the accounting concepts and convention on which basis these are called accounting principles, on which these basis the particular bookkeeping and financial accounting activity is carried out. Now we are going to see how the procedure of recording business transaction into journal starts. For that purpose, we will draw a chart. All accounts. What is account? Account is a summary of journal transactions. So after journal entry, a ledger account is prepared, and ledger account is prepared for all personal, real and nominal accounts. Now when you say account, it is a summarized record of particular account. So for example, machinery account or Raman's account. Raman's account will represent the transactions of business with Raman. So this account is a classified entries of a particular account. It can be any type. So for this purpose, all accounts are classified into three types: personal, real, and nominal. Now let us prepare a chart to show the classification of accounts. Now this chart is going to help you in passing journal entries. Very important chart we are preparing. The first type of account is personal account. As the name suggests, it relates to persons. Now persons can be individuals, partnership firms, joint stock companies with whom the businessman deals. For every person, a separate account is maintained, and for every individual, a separate account is maintained. For example, all customers are having their accounts in bank. So bank has to prepare every account of customer separately, because every customer wants to know transactions happened in his account and what is the balance in his account, so that he can decide how much money he has, how much he can spend, how much he has to save, everything. So this is called a ledger account related to persons. So all types of individuals, partnership firms, companies, banks, all consist of personal account. So there are two types of person: real person and artificial person. A partnership firm and company, they are called artificial person. The signing authority of the company represents these accounts. So all these include personal account. Now we will take example. For example, suppose Amit is a customer. Amit's account is personal account. PQR limited account is personal account. XY partnership firm account is personal account. So all these are examples of personal account. Now sometimes the personal accounts are taken together and a group is created. For example, debtors and creditors. Now here, as the term comes, we will see the difference between debtors and creditors. Who are debtors of the business? Now when the company sells goods to the customers on credit, the customer has to pay the amount after the credit period is over. So the customer owes to the company and they are called debtors of the company. Exactly opposite, creditors. When the company purchases goods from supplier on credit, means the payment is done after the credit period is over. So those companies, suppliers, becomes creditors of the company. Creditor means a person to whom business is liable to pay, and debtor means a person from whom business get cash. So these are called the debtors, creditors. These are called groups. Now, when you come to know what is personal account, there are golden rules of accounting which are followed everywhere to decide which account to be debited and which account to be credited. Now, what is the golden rule of personal account? The golden rule is debit the receiver, credit the giver. So these rules you have to by heart. For personal account, the golden rule is debit the receiver, credit the giver. What does it mean? The person who receives from business, his account has to be debited, and the person who gives, who is giver to the business, his account to be credited. So it is called debit the receiver, credit the giver. After this, first we will understand types of accounts and rules of accounts, and then we will understand how they are applied in passing the journal entry. So this is all about personal account. The second account of is real account. The word itself says that what is real account? Real account means those are not persons, but they are assets of the company. So these are impersonal account. No person is involved in real account. All types of properties, assets, possessions of business, they can be tangible, intangible, they are called real account. So all accounts other than person, then they should be assets or belongings of business. Assets or belongings of business, they comes under real account. So all types of properties. Now what is the difference between tangible and intangible? Tangible asset means the asset which you can see, touch, feel, you can value it easily. That is called tangible asset. And intangible asset which you cannot touch, value, you cannot feel, they are called intangible assets. Example, tangible asset, furniture, machinery, building. These are all tangible assets. And intangible asset which you cannot see, goodwill, trademark, patents, etc. So all types of assets of business come under real account. These are the examples. Now comes the golden rule. The golden rule of real account is debit what comes in, credit what goes out. Now let us understand what does it mean. Credit what goes out. When you will debit, whenever something is coming into the business. So debit the account which is coming into the business and credit the account which is going out of business. So the rule is simple to understand. Debit what comes in, credit what goes out. Now for example, if you purchased goods, goods are coming into the business. So they will be debited. So goods comes under real account. Cash comes under real account. Now last and third type of account is nominal account. Now the account which is not person, which is not real, is nominal account. These are called fictitious account because they are created for the purpose of accounting. So you cannot see these accounts. Fictitious accounts. No person is involved, no asset is involved, they are fictitious. Now all types of expenses, losses, income and gain which are created for the business, all types of expenses incurred by the business, all types of incomes received by the business, gains made by the business, and losses incurred by the business come under nominal account. They are fictitious, they are created for the purpose of accounting. So, for example, rent account. Rent can be income or expenditure of business. So, rent account, commission account, n number of expenses, electricity expenses, telephone expenses, office expenses, all these accounts come under nominal account. Now, what is the golden rule of nominal account? Debit all expenses and losses and credit all incomes and gains. Now let us repeat the rules. Personal account, all types of person come. The receiver will be debited and the giver will be credited. Real account, whatever is coming into the business is debited, whatever is going out of business is credited. Then all types of expenses and losses of business are debited and all types of incomes and gains are credited. So this particular chart you have to keep in front of you for initial practice of journal entries. So what is journal entry? Recording business transaction into the books of accounts. Now we are going to start with the primary book or book of primary entry, which is called journal. So journal is the book where the particular transaction is entered first. Now we will see what are the steps of journal entry. Now when the business transaction is given to you, you have to read the transaction carefully. You have to also think about in whose books of accounts you are passing the entry. Now suppose the entries are given, you are asked to pass journal entries in the books of Ram. Then what you have to do first? You have to think from Ram's business point of view. Every transaction you have to think from Ram's business point of view. So first you will read the transaction carefully. Then second step, you will find two accounts involved in the transaction. As we have seen in the principles of double entry bookkeeping as well as dual aspect concept, every business transaction involves two accounts. So you have to find out two accounts involved in the transaction. Step 3. We have seen this particular chart. So you have to classify the account as personal, real or nominal. We have already seen examples or what type of accounts come under these three headings. So you have to classify the two accounts which you have found out from the business transaction. After this, you have to apply the golden rules, which we have seen for three types of accounts: personal, real, nominal. So you have to apply the golden rule and decide which account will be debited and which account will be credited. And then once this is decided, you have to pass journal entry and summarize it in the narration. Then we are going to see format of journal and how the journal entry is passed in the journal. Now initially we will start with the examples that how to pass journal entry. Now first transaction we will take. Mr. Raman purchased goods worth rupees 5 lakh from Mr. Rajan. You have to pass entry in the books of Mr. Raman. Now step 1. First you have to think the transaction from Mr. Raman's point of view. So what is the transaction? Raman purchased goods worth rupees 5 lakh from Rajan. Raman has purchased goods. So step 1, find out two accounts involved into the business transaction. Purchased goods, so it is goods account or purchases account. Second involved is Mr. Rajan. He has purchased goods from Mr. Rajan. So it is Mr. Rajan's account. Now we will apply next step. Two accounts involved. Now we have to apply the next step. We have to classify the account personal, real or nominal. Now goods account, as you can see, it is a real account. So step 2, which type of account it is? Real account. Next account involved is Mr. Raman. So as you say, or whenever any person is involved, it is a personal account. Step 3, apply the golden rules of account. Real account, the golden rule is debit what comes in, credit what goes out. Now debit what comes in. Now you have to ask next question, whether goods are coming into the business or going out of business. When you purchase goods, goods are coming into the business. You will debit. Now Rajan's account is a personal account. What is the rule? Debit the receiver, credit the giver. Now you have purchased goods from Rajan. So for business, Rajan is giver of goods. His account will be credited. So how to pass entry? Goods are coming in. Goods account debit. The amount is rupees 5 lakh to Rajan's account. 5 lakh. Now for every transaction in journal, you have to write a narration. Narration is the same transaction in brief. So the narration is written like this: being goods purchased, from Rajan. Amount is not written in narration. So the narration is being goods purchased from Rajan. So this is called journal entry. Now afterwards we are going to see the classification of goods account. We will take one more examples. Just now we have seen goods account. Why? Because you should understand whether coming in or going out. Now we will see in practice how the goods account is classified for convenience. purchases account, sales account, purchase return, and sales return account. Why this classification is required? This classification is required because there are always n number of transactions with goods. When you say business, you always purchase goods, sell goods, everything related to goods, you have to carry out the transactions. Now, suppose you want to know what are the purchases made. You will not able to locate if you are passing entries with goods account. So, when you say whenever goods are purchased, if you enter under purchases account, then it will be easy to know purchases made during a month, during 6 months, during year, etc. Sales account. When the goods are sold, they are called sales account. Why? You will come to know easily what are the sales made during the month, during year, during 6 months, etc. Now these are the four accounts which got repeated in goods. Whenever after purchases, due to various reasons, maybe the goods are not as per quantity, as per quality, defective goods, for various reasons, you return goods, they are called purchase return. Then same way, when you have sold goods and the customer returns goods, they are called sales return. So there are various reasons that why the customer returns goods. It may not be as per quality, quantity, it may not be as per requirement. So all these are briefly described under goods account, and henceforth we will use these four accounts while passing journal entries. Now we will take one more example. Sold goods to Radha for rupees 8 lakh. Sold goods to Radha for rupees 8 lakh. Step 1. Find out two accounts involved. So here again, if you see, two accounts involved are goods and Radha. But as the goods are sold, instead of goods, we will use sales account. So first account we will write Radha and sales account. Now here, instead of goods account, we will use sales account. But hidden account is goods account. So it is a real account. Step 2. Classify the accounts. So Radha's account is a personal account. And sales account is a real account. Next step, apply golden rules. The rule of personal account is debit the receiver, credit the giver. Now when you have sold goods to Radha, Radha is receiver of goods. So her account will be debited. Radha is receiver. Business has sold goods to Radha. Then sales account. Actually it is a goods account. Goods are going out of business. The rule is debit what comes in, credit what goes out. Goods are going out. So goods account or sales account will be credited. So the entry will be Radha's account debit to sales account. The amount is rupees 8 lakh. As per principles of double entry bookkeeping, one account is debited and the other account is credited by the same amount. So the amount of debit and credit is same. So these are the steps which are followed to pass journal entries. Next, paid for office expenses rupees 25,000. Step 1, find out two accounts involved in the transaction. Now the two accounts involved for. Now paid for, here cash account is the hidden account. It is never mentioned that paid for office expenses in cash. It is implied when you pay something, you pay cash. So what are the two accounts involved? Office expenses account and cash account. Every business transaction involves two accounts, and step 1, you have to find out those two accounts. Now office expenses account. Next step, find out, classify the account. Now we have seen personal account, real account. So these two accounts are not, it is a fictitious account of expenses. So it is nominal account. And as we have already seen, cash account, goods account, these are real account. Step 3, apply the golden rule. So nominal account, the rule is debit expenses and losses, credit incomes and gains. This is expense of the business, so you have to debit. Cash is going out, so you have to credit. So right here, expenses going out. Cash is going out of business. Expenses account debit and cash account will be credited. So what will be the journal entry? Office expenses account debit. Office expenses account debit 25,000 to cash account 25,000, being office expenses paid. Now here we have passed entry for office expenses. All types of expenses which are paid, you have to pass the same entry. So all types of office expenses, any types of expenses, the entry is office expenses account debit or any type of expenses account debit to cash account. Sometimes the expenses are paid by check. There you have to take bank account. So on similar lines, all expenses entries will be done. Received commission rupees 86,000. Now for business, it is very common. The business has to pay expenses and the business has to receive income. Now now if you observe here, commission is income because the business has received commission. Now again, cash account is implied. it will not be mentioned in the transaction. Whenever expense is paid or income is received, cash account is implied. So what are the two accounts involved? Cash account, commission account. Step 2. Classify the accounts. Cash account is real account and commission account is nominal account. It is not a person, it is not an asset, it is a fictitious account. It is called nominal account. Step 3. Apply golden rule. For real account, the golden rule is debit what comes in, credit what goes out. The business has received commission. It means cash is coming in. So it is debited. For nominal account, the golden rule is debit all expenses losses, credit all incomes and gains. Commission is income, it is credited. So the entry is cash account debit to commission account. 86,000. Same amount on debit side and credit side. Received commission. The business has received commission. Now here we have seen how the business has received commission. Any type of income the business receives, the same entry is there. Cash account to that income account. Interest received, rent received, same type. Now, instead of cash, if the business receives through check, the difference will be instead of cash account, there will be bank account. Now, last example we will see. Withdrawn cash for personal use, rupees 12,000. Now this is a different type of entry. Here we are going to see application of entity concept. This is the transaction between owner and business. The owner has taken cash from business. Now what are the two accounts? When owner withdraws cash, you use drawings account. So the first account is drawings account. And second account is cash account. Cash account is again implied account. Here it is specifically mentioned withdrawn cash for personal use. As it is for personal use, it is treated as drawings. If it is for office use, then the entry will be different. Now what is the type of drawings account? Drawings account is a personal account. Actually it is owner's account. So this transaction is specifically between owner and business. And as the entity concept says, whenever there is transaction between owner and business, it is treated separate entity and it is passed in the books of business. So drawings account comes as personal account as it is owner's account. Cash account is real account. Now apply the golden rule. Drawings for her personal account, debit the receiver, credit the giver. Now here owner is a receiver of cash. So receiver and cash is going out. So the entry will be drawings account debit rupees 12,000 to cash account. Cash is going out of business. 12,000. Narration. Withdrawn goods, withdrawn cash for personal use. The cash is withdrawn for personal use. So this we have taken examples and we have studied the steps of passing journal entries. By practice, you may not write these steps. You can directly pass journal entry. Now we will see format of journal. Book of primary entry. First entry is made in journal. You have to solve the example of journal in this uniform format. There are 5 columns. On the top, you have to always write in the books of, in whose books you are passing the entry. First column is always date. It is a day-to-day basis book. Particulars. Ledger folio. Debit amount rupees. Credit amount rupees. Debit amount rupees and credit amount rupees. As we have seen in the principles of double entry bookkeeping, one account is debited by the same amount other account is credited. Now we will see the meaning of each column. In the column of date, you will always write day to day. You will pass entries day to day and the date will be written in this particular column. In particular columns, you will actually write journal entry. Now LF. What is the meaning of LF? LF means ledger folio. Now after journal, the next book is ledger. So you will, every journal entry is posted to ledger. Now suppose this journal, and it will be posted in 2 accounts as 2 accounts are involved. So if the ledger page number will be written in this particular column. In journal, you will give reference of ledger page number and amount will be written in both columns. So we will pass one entry. I will show you how to write entry in the format of journal. Suppose 1st July 2018. The entry is of purchases. Purchases good. So purchases account debit. $25,000 suppose to cash account. You will write in the column of credit 25,000. So the amount will be same in debit column and credit column. Narration you will write in particulars column. Being goods purchased on cash basis. Being goods purchased on cash basis. This is the way of passing journal entry. Now, this way is followed uniformly. So, whenever you are solving question on preparation of journal, you have to follow the same format. All entries you will pass and then at the end you have to take total of journal. So, we have seen the first books of account, that is journal. So journal is meant for passing entries day to day. Primary entry, first making entry. As we have seen, the journal entry is passed when the transaction is over. Business transaction is over and you have the evidence, you have the proof, legal proof, document. On that basis only you will pass journal entry. So we will see what is the utility of journal. The first utility is each and every business transactions, they get recorded in the books. So you do not forget anything. At the end of the day, you pass all transactions. So no amount gets omitted, which helps in financial accounting. Then secondly, journal can be used as a proof against any legal case because you have recorded everything and you have also evidence of that particular thing. So in journal on day-to-day basis you can find each and every transaction of business. So it is having a great utility. You can identify error made if at the end trial balance do not tally. You have to refer to journal. Then as the narration is written, the transaction is summarized. You can refer directly to the transaction. You will come to know what is the transaction happened exactly on that date. So thus the journal is having high utility. So to summarize or to conclude, we have seen in this particular second unit account mechanics, and the first part it is called accounting cycle, recording business transaction into the journal. So now you have to make practice of journal entries by solving various business transactions. Thank you.